Hey, I'm Tonya Yudisky with Misty Newsome CPA, and today we're going to chat about entities, both legal and tax, and what they really mean. Have you ever been confused about what type of business entity you should choose? Maybe you've heard terms like LLC, S-Corp, and C-Corp thrown around, and you're wondering, is that a legal thing? Is it a tax thing? Do I need both or one or the other? You're not alone. Today, we're going to break down the key differences between legal entities and tax entities, and then we'll walk through the pros and cons of each tax classification so you can make informed decisions that'll protect your business and save you money. Let's start with legal entities. A legal entity is how your business is legally recognized by the state. It determines things like who can sue or be sued, who owns the business, how liability is handled, and what you're required to file each year. The most common legal entities are sole proprietors, general partnerships, limited liability companies, otherwise known as LLCs, and a corporation, which you sometimes hear as an Inc., INC. Each of these have their own rules for ownership, liability, and compliance. For example, a sole proprietor offers no legal liability protection, but it's easy to set up. Typically done with a DBA at your local county courthouse. An LLC offers liability protection while remaining flexible, and a corporation is very formal, structured with bylaws and board meetings required. But here's the kicker. Just because you have a legal entity, it doesn't necessarily mean that's your tax entity. Let's discuss that next. The IRS lets you choose how you want your business to be taxed, sometimes completely independent of your legal structure. There are main tax classifications. You have disregarded entities, commonly referred to as a Schedule C or a Schedule E, a partnership, an S corporation, known as an S Corp, or a C corporation, known as a C Corp, or an entity tax return. Let's break that down. If you're a single member LLC, the IRS treats you as a disregarded entity, meaning that you file your business taxes on your personal return, like a Schedule C or a Schedule E, or even sometimes a Schedule F. If you're a multi-member LLC, which means you have more than one person in your LLC, you're taxed as a partnership by default. But LLCs, whether single member or multi-member, can elect to be taxed as either an S corporation or a C corporation if that works best for your goals. If you form a corporation at the state level, you are a C Corp by default, but you can file to become an S Corp. So while your legal entity determines your liability and your structure, your taxable entity affects how you're taxed. There's a big difference there. So as you can see, the IRS gives you options. This flexibility can be powerful for tax planning, but it also means you have to understand the trade-offs. For instance, a sole proprietor or a disregarded entity, like a single member LLC, is a simple file on your personal tax return. It doesn't have any business tax return, which are typically filed at a separate date than April 15th. And they have a low cost to operate. The con is that there's not a lot of legal protection. All profits are subject to self-employment taxes. Those are our Medicare and Social Security taxes. And they are harder to raise capital inside of. Now, if you have a partnership, now that's two people forming a multi-member LLC, or even in some cases, a husband and wife going into a sole proprietorship together, which is legal in several states. They have to be filed on a 1065, which is due on March 15th, and you get issued K-1s. And while it is a slightly more complicated tax return, it's also known as a pass-through taxation because you're taxed at your individual level and not your entity level. So they are only taxed at your partnership level on your partnership personal return. And you can also have some flexible profit sharing structures so that not everybody is 50-50. This could be a 90-10 or a 70-30 kind of split with both profits and liability. Now, some of the cons are general partners typically have personal liability unless it's a legal limited partnership. Partners also have to pay self-employment tax on all of those profits that pass through to them. And when disagreements happen, as they do, because no two people will agree 100% of the time, those disagreements can be very tricky unless your agreements are really solid legally. What about an S corporation? Now, this is kind of that legal limbo in the tax world that allows different legal entities in order to be taxed as a pass-through corporation. This avoids some double taxation, especially for C corporations. So your profits pass through to your owners and are taxed similarly as a partnership. So they're taxed on the personal tax return. Owners can pay themselves a reasonable salary. So you're on W-2 for yourself. And that's the only piece that you pay self-employment tax on. The rest of your distributions are not subject to self-employment tax. So it's very popular for small business owners who are making a decent amount of net profit. Now, some of the cons with S-Corps are that you're legally limited to under 100 shareholders and they have to be U.S. citizens. You have to pay a reasonable compensation to all of your shareholders, so any owner employees. And the S-Corp taxation, the 1120S forms, are more complex than most of your other forms. And there's payroll requirements that have to be filed every quarter and at year end. Now for a C corporation. Some of the great pros in this is that it gives you full liability protection from everything, as the C Corp is completely separate from you, the individual. It becomes its own person. There's no limit on shareholders or foreign ownership interests. You can get quite a few fringe benefits to be written off as tax deductible, and they're great for raising capital, reinvesting profits, and scaling long term. Some of the cons: you end up with double taxation a lot of times since profits are taxed both at the corporation level, which is currently 21% across the board, and then you get taxed again when you are paid dividends on your shares. Now that dividend rate is based upon your personal income level. There's also quite a few complex compliance requirements and regulations as far as board meetings that have to be documented. Depending on the state, there's lots of other paperwork that has to be filed. And you also have to deal with payroll and all of those other additional tax forms as well. You have to file a Form 1120, and that is due on April 15th. And you also have to deal with a lot of your state level income tax forms as well. Now, an often overlooked area where your entity choice really matters is selling your business. Sometimes, most of the time, we overlook how we're going to get out of our business at the end. But when the options come to start talking about how to choose our entities, we really need to focus on what those out options look like and how they'll affect us on the long run. So if you're a sole proprietor or an LLC taxed as a disregarded entity, a sale is usually considered an asset sale. So that means that they're buying capital goods or capital assets. Well, if you know anything about the tax code, that means that you're looking at capital gains as far as taxes go. So you're not purchasing an entity, you're purchasing things, whether that be equipment, contracts, goodwill, your customer list, all of those types of things. And therefore, you have to pay the taxes based upon the capital gains rate on those things. For S-Corps, you might sell stock or assets, so you get that choice that comes into play. Selling stock can be better for the seller because you get capital gains treatment, while buyers often want an asset sale because then they're able to depreciate those asset purchases. C-Corps often face double taxation on asset sales, once at the corporate level and again when proceeds are distributed to the owners. So if you're selling something like a computer or those types of things, the profit gets taxed at the corporate level, and then those leftover distributions in the form of dividends also get taxed when that check gets cut to you. So this is a huge area to plan ahead for. If you think you'll sell one day, your tax entity should align with your exit strategy. Here's the bottom line. Your legal entity is about protection and structure. Your tax entity is about how much you owe Uncle Sam. Choosing the right setup can save you thousands in taxes and protect your assets in the process. That's why it's so important to work with a CPA and a business attorney when setting up or changing your entity structure. If you're unsure what's best for you, don't guess. Book a consultation with a trusted tax professional like us. This is one of those decisions that's worth doing right the first time. Thanks for watching, and if you found this helpful, go ahead and like, subscribe, and drop a comment with your question, or share this with one of your friends that's kind of facing this situation right now. See you in the next video.